Good day, subscribers. Thank you so much for joining me today. I am Jeremy. This is the Financial Education Channel, and today we're talking about bear market. We're talking about the pure insanity of what goes on during a bear market. I'm going to take you through 11 steps that actually occur during a bear market. Yesterday's video, I went into depth on what a bull market is, what happens during a bull market, and today I thought it'd be fun just to cover a bear market. What's really going on during a bear market, guys? If you enjoy this video today, hit that thumbs up button and leave me a comment. I would love to see it, guys. So let's go ahead and get into this bear market stuff. So number one, fear is powerful and fear breeds more fear. So what happens in a bear market is you have everybody on TV talking about how bad things are. You have all the newspapers, all the internet talking about how bad things are. Everybody's talking about how bad things are, and fear breeds more fear. And fear is the most powerful thing that happens in humans, guys. It is most powerful. So this fear just makes for more fear and more panic out there, and everybody gets so scared. And this is what occurs in a bear market, guys. Fear on fear. Why do you think political ads, most political ads are geared toward what? They're geared toward making the other candidate seem like avoid them. It's going to be scary. It's going to be doomsday if you elect them. Look at the Hillary ads and look at the Trump ads. There were so many Hillary ads that ran against Trump that were like, oh, so fearing, you know, if you elect him, you're electing a racist and women are going to go down the tubes and everything's going to be bad if you elect him. And it was all fear, right? And same thing that Trump did against Hillary. So many ads were, oh, if you elect her, you're electing corruption. You're electing a candidate that you can't trust, that's, you know, behind the billionaires and whatnot. All those kinds of things, guys. And that goes for pretty much every single political ad out there. It's all geared toward causing you to be fearful because people know fear creates more fear, and fear is so powerful in humans. So during a bear market, it's just fear breeding fear, guys. And that's what creates this whole negative concept. And then you see numbers come in, and then everybody talks about those numbers. And it's just so powerful, guys. So that's the number one thing that goes on during a bear market. It's fear breeding fear. Number two thing that goes on is everybody begins to focus on macroeconomics. Everybody begins to focus on the economy, the US economy, the world economy, the economic numbers. The whole focus begins to just get all macroeconomics. Anything that's happening with individual companies, that's back page stuff. That's back page stories, guys. That doesn't get any attention paid to it. Even if that company is really executing and whatnot, it doesn't get any TV time. It doesn't get any attention in the newspaper and whatnot. All the talk is just on macroeconomics and what employment rate came out and what are wages going down and what is GDP at? What is GDP going down? Everything becomes just about macroeconomics. People could care less. The media could care less about microeconomics at that point. People could care less about what individual companies are doing. It's just all begins to focus on macroeconomics. And when the macroeconomics are going bad, that goes back to part number one, which is just fear breeding fear. So those are the first two steps that happen during a bear market, guys. Number three. People begin to flock to huge companies that have good balance sheets to invest in and sell necessity type products. So companies like Johnson & Johnson, Procter & Gamble, you know, some of these huge corporations that have good balance sheets and they sell necessity products like toilet paper and paper towels and Tylenol and all this stuff, guys. Those are necessity type products that doesn't matter what's going on in the economy. People are going to buy that stuff because it's necessity related, and those companies are huge and they have good balance sheets. So people begin to flock to those type of companies, and those companies generally hold their value much better than any of the other companies out there that are want type companies. So those companies are actually really good to invest in a bear market if you're going to be invested in anything during a bear market or going toward a bear market, just because people own those stocks, guys. They love good balance sheets during that time. Everybody's paying attention to balance sheets, and everybody loves necessity type companies. You know, a lot of food manufacturers like Conagra Foods and some of the biggest ones like that, General Mills, those companies all do okay during a recession and during a during a bear market because they're necessities, guys. People are going to spend the money on it no matter what. Next one up here, guys, is number 4. Any type of leisure companies, any type of businesses that are selling wants, those stocks generally get destroyed, just absolutely obliterated, because the investment community kind of understands, okay, we're in a bear market, which means we're probably in a recession at that time. So anything leisure related, people are going to cut back on that. Anything that's a want and not a need, people are going to cut back on that kind of stuff. And those stocks just get absolutely hammered, guys. They just get destroyed. If you look back at a lot of the leisure type companies, whether it be resort companies or companies selling wants like, ATVs or motorcycles, Harley Davidson, back at some of those stocks during the Great Recession, during that bear market. Some of those stocks just get absolutely destroyed, guys, because they're want type companies, they're leisure type companies. So if times are hard, those stocks are going to be the ones that drop the most because those are going to be the first ones that people cut back on. Those type of activities, guys. So that is another thing that occurs during a bear market. That's number 4. Number 5, companies with low cash and heavy debt. Those companies get destroyed. Balance sheets become so important during a bear market, guys. People really start looking at balance sheets and really start paying attention. Whereas in a bull market, like we talked about, no one gives a crap what a balance sheet looks like. Bear market, different story. People start caring about that. And companies that are high in cash, very low in debt, those companies are seen as safer because there's no imminent danger, even if the economy does continue to struggle, even if this bear market does continue to struggle. Those companies are still going to be okay. So people tend to go more toward those strong balance sheet companies. That's why I preach balance sheet all the time to you guys. Balance sheet is so important. It's one of the most important things when investing, because when these hard times come, bear markets come, balance sheets do start to matter. They do start to matter. When recessions come, balance sheets do start to matter. When a company struggles a little bit, balance sheets do start to matter, guys. That's why balance sheets are so key. Next one up, number 6. Selling creates more selling. Basically, stock prices begin to fall. This guy sells. This big fund manager sells. That stock goes even lower. Someone else needs to sell at this point because the next fund manager, he doesn't want to, I guess you could say, perform even worse than that other fund manager. They see the market tank and say, crap, I got to sell that stock too. That stock goes even lower. Then you have margin out there. You have debt that people end up getting margin calls. Big funds, individual investors start getting margin calls, ones that were playing on margin. They start getting margin calls, and then they're forced to sell. The computer algorithms take over, and selling breeds even more selling in the computer systems and whatnot, guys. So selling breeds selling, and it just creates for a very, very negative snowball that just starts rolling, and once it starts rolling really bad, it's hard to stop it, guys. It's really hard to stop it, which is why from 2008, the stock market was, 12,000, 13,000. And then by the next year, it was 6,700, guys. How's it dropped that fast? It's selling, breeding, selling, guys. That's how it happens. And it's a really scary time, and it's no fun unless you're buying short-term puts and some of those kind of things. And then you're doing pretty dang good, guys. Next one up, number 7. People and funds that are on margin get wiped out. They get absolutely wiped out, guys, because the market's going down so fast. And if they're long stocks and they're on margin, they're getting those margin calls like we talked about. They're having to sell at really crappy prices, and over time they just end up getting completely wiped out. That's why it's such a attractive thing to maybe say, you know what, I'm going to start a margin account when we're in a bear market, because at that time I can invest so much money, and then that's the best time to invest, because then it's going to go up a ton and the stock market is going to double a couple years later. Well, the scary thing is, how do you know when the bottom is? And if you're going on margin, how do you know it's not going to keep going down? And then you start getting those margin calls in, and then you get wiped out over time because the next margin call breeds another margin call and whatnot, guys. So people that are on margin and funds that are on margin, they just get wiped out in a bear market, guys. Unless they're margining out to short sell, then they're probably doing pretty dang good. Number 8, people buying short-term puts make money like crazy. Short-term puts, ones that are dated out a week, 2 weeks, a month from now, those people start making so much money because you can generally get those type of option contracts for pretty cheap. You can get some of them that are out of the money for, 10 cents, 5 cents, 20 cents, very cheap per contract. So you can get those, and then with the markets dropping substantially, and to say that stock drops 10% in a week or 2 weeks or whatnot, the options did not have that priced in, so you end up making bank if you're buying short-term puts. So people that are buying short-term puts, there's videos of people that have become millionaires from being short-term puts and just playing it right and buying short-term puts and doing that all throughout a bear market, because there's just so much money to be made. Same thing a strong bull market. If you're buying short-term calls, you can make a lot of money if it's a really strong bull market and you're betting on the right companies at that time, guys. So anybody going short-term puts at that time makes a lot of money in a bear market, guys. Number 9, gold and a lot of other precious metals, specifically gold, they generally hold their value or they actually increase in value. Gold is seen as a fear indicator. When people get scared, when bear markets come up, gold generally performs really freaking well, guys. You can look back at a lot of recessions and whatnot. Gold held its value way better than the stock market held its value. And then you go ahead and look at how it did. Sometimes it did a lot better, not only a lot better, but actually outperformed where the gold actually increased in its value versus the stock market decreasing and decreasing. So gold is a good one to be into if people are scared and people are panicking, those kinds of things. They generally flock to gold because a lot of people like to put their money somewhere, not just on the sideline. So they put it in gold because they feel like that's a safe place to be. I'm not a gold investor. I don't really believe in gold investing, but it's certainly a great place to go if things are bad, guys. It's just the way it works. I don't know why. It's just the way it works, guys. Number 10. PE ratios no longer matter in a bear market. PE ratios mean nothing in a bear market. Reason being is because generally in a bear market, we're in a recession or going toward recession. And when that type of environment's out there, PE ratios and forward PE ratios, they mean nothing at that point because the company probably is not going to earn as much as they earned last year. They might even take a loss or something like that. So if a company says it's got a forward PE of, let's say, 10, who knows? It might not be a 10. It might actually be a 20. It might not be anything at all because then maybe all of a sudden they'll go unprofitable because things will be that bad. So forward PEs or PE ratios in general, they don't matter at all in a bear market. They really don't, guys. No one gives a crap if that company's trading at 11 PE during a bear market. They really don't because how do they know the company's even going to get close to that this year if the environment's that bad, guys? So PE ratios, they mean nothing in a bear market. Number 11. Retail investors unfortunately leave the stock market and many of them never return ever. Many people just get scared away, they get traumatized by the situation and they never come back. They never come back because they're so frustrated. So many of them sell at these bottom crap prices and get out and they lose so much money and they're like, oh, I lost 80% of my money or 60% of my money or 50% of my money or whatever. The stock market's a big scam and they just get a negative feeling for the rest of their lives. So many millions of people that always happens to, guys. It really does. So you got to really watch out for that. And if there is a bear market coming, you got to kind of know how to play some of these things so you don't end up in that group of people that just get frustrated and never want to invest in a stock again for the rest of their lives. They're like, I'm just better off putting my money under a mattress and investing in this crap because they sell out at these crap prices, guys, and they have just a really bad experience. They lose a lot of money. And then the thing that probably even frustrates them more than that is another year or two down the road, the stock market is even higher than when they started investing. And then they're really pissed off because they're like, if I would have just kept my stocks, I could have freaking made this much money. So that is the unfortunate side effect of what happens in a bear market, guys. I hope you really enjoyed these 11 steps on what happens during a bear market. This stuff does happen, and I hope you guys understand it. I've been through a bear market because when I started looking into investing, I wasn't invested yet, but I was looking into investing. It was 2008 into 2009, and then I started investing toward about the middle of 2009, and at that time, things were starting to go up, but I had seen the full bear market play out because I was paying attention to things because I was looking into investing. So I've seen one bear market in my lifetime, and I've seen like little minor bear markets come here and there where there's big worries in China or whatever out there. I've seen minor ones, but I saw the major one in my lifetime so far. You guys are going to see one in your lifetime, if not many in your lifetime. Believe me, it's going to happen. I hope you guys enjoyed this video today. Subscribe if you haven't. I talk personal finance on the channel. We talk entrepreneurship. I'm a business owner. I give entrepreneur type tips. We also talk the stock market the most on this channel, including what we did today. Thank you for watching, guys, and have a great day.